Hi everybody, I'm Gregg Johnston from Stephenson, Harwood. I've been based here in Singapore since 2002, focusing on all aspects of shipping and offshore finance. So today we've got a panel on alternative finance and private equity in shipping. I'll first of all just introduce the panel. To my left, we've got Nick Meer from JP Morgan, Global Transportation Group, Alternative Assets. To his left, we've got Mr. Philip Clausius, founder and managing partner of Transport Capital Pte Ltd. And the last panel member is Mr. Martin Hugger, from the managing director of Meerbaum Capital Solutions Inc. So I think just to kick the panel off, so I don't misdescribe what you actually do, if you could just spend maybe 1 minute each explaining your respective organizations, and in particular your focus on shipping, that would be great.
Greg, I hate to steal your thunder, but Martin is Philip and Philip is Martin.
Sorry, I thought you were... That's correct.
Good. So,
Philip, kick off.
All right. Philip Clausius at Transport Capital. There's a lot of talk about private equity or like structures not having risen to the importance that a lot of people were expecting in Asia. I think that is a reflection of the global structure of the asset management industry. If you go to the big pools of capital in Asia, the likes of Temasek and GIC, who allocate a substantial part of their wealth to external managers, you will see that they will allocate 80 to 90% to US asset managers, for the simple reason that they have been in this business for so much longer than sort of the homegrown asset management companies. Now, as far as we are concerned, we have been fortunate enough to been the shipping partner over the last 4 years of one of these large, if you will, homegrown asset management companies, in our case called PAG in Asia, which is a $20 billion multi-strategy fund. And we have been fairly active. They have made a number of substantial investments in the industry, both in a high-profile JV with the BW Group, but independent of that, we are currently managing 30 ships for them in 5 separate investment vehicles that we have acquired over the last few years on their behalf. And I can say that we have managed this exposure from them from A to Z, and all these investments are still running, have not been exited, but the cooperation certainly has been a very positive one. So I would not say nothing has happened in Asia, but clearly it's a fraction of what's been happening in the US, and I consider this normal. But as everything in Asia, it will grow and it will change over time. So we're in the right place.
Okay, my name is Martin Hugger. I'm from Meerbaum Capital Solutions. That is a cooperation between Oaktree Capital Management, one of the largest US private equity firms with about $100 billion under management, and the Greek shipping group of Petros Pappas, that includes Star Bulk, Ocean Bulk, and Product Shipping and Trading. On the Greek side, we have about 100 vessels in the water, and what we are doing is we help Oaktree to avoid the mistakes that I've seen as a former banker over the last 20 years, and most of them made myself at some stage. So we provide Oaktree, when they consider senior funding, with the expertise, whether this is a good vessel, whether the vessel is maybe in a bad shape but can come back, can be brought back, whether the vessel has good commercial prospects, and also what needs to be done to maintain her properly over time. So we come from the shipping side and look very much at the asset. We, of course, also have a view of what this vessel will make in the market, so what kind of income we can see and what kind of OPEX this client may face when operating this specific vessel. And we're also there to provide for smaller companies that don't have this huge technical expertise that our guys have, some, let's say, second opinion on a vessel that they intend to buy. We've been doing this now for the last 2 years, and originally I expected to see mostly smaller European companies because the European banks have been most hit by the shipping crisis and the financial crisis. Interesting for me, but maybe not surprising for more Asia-related companies. We've seen also a lot of business coming out of Asia because there seems to be a need here that traditionally was covered by larger European or US banks that currently is not catered for by them. So this is more or less what we do.
Thank you.
Liquid vessels and no specialities and no cross-selling because we don't have the products. We leave that to Michael. And we try to not make the mistakes that banks were forced to do, and especially go into the regulatory gap that we see for the more volatile side of the business.
Thank you, Martin. Just for the benefit of the audience, are you able to maybe touch upon how you're differentiated from Fleetscape, which I believe is also effectively sponsored by Oaktree?
Tobias is counterparty focused and needs a stable and visible cash flow, and we are asset driven. So we are fine to have a vessel that has a negative cash flow as long as the amount we finance is what we consider a manageable risk in relation to historical and future expected values of the vessel.
Thanks.
Great. My name is Nick Meer. I'm with JP Morgan Asset Management. We're a global leader in the asset management business. We run capital for our institutional clients across the traditional asset classes of equities and fixed income. We're also a leader in what we call alternative asset classes, which include real estate, infrastructure, and more importantly for this, transportation assets. We've been active in the maritime space for the last 9 years. We currently have a portfolio of about 88 vessels in total across tankers, containers, car carriers, dry bulk, as well as heavy lift as well. We invest through structures of both joint venture, so investing our capital alongside the good names in the industry to help grow their businesses and gain greater scale. We also do it on a wholly owned basis as well. We have internal teams who handle both the commercial side of the business as well as technical managers that oversee our technical management companies that we invest alongside. We've been here for 9 years now, and we're making a strong capital commitment to the industry. We have 22 people in total across the space, and as I said, we take a long-term view and have the ability to hold assets for long terms. We can hold assets up to their full economic useful life, which I think it makes us very different from what is traditional private equity.
Thanks. We had some pre-agreed questions, but actually, to make things interesting, I just want to pick up a point from the previous panel. So it was raised that private equity in shipping has not worked. How would you react to that, Nicholas?
I'd say to Joop's comment there, as a generalization, I think that is correct. I think there's been many challenges of how private equity has entered in the industry, but I think there are groups who've found the right vintage periods and found the right investments. I think in general, groups like ourselves who invested across multiple asset classes within the segments have tended to do better in the space and have found returns for our clients.
Philip?
I think private equity has done as well or as poorly as all the ship owners. I mean, the returns are no different. And, you know, they have decided to allocate capital at a certain point in the cycle, as have ship owners. And sometimes it works out and sometimes it doesn't work out. That's the nature of the cyclical game. So I think there's nothing particularly special about it. I know that private equity has largely term money, so there is an issue with running against a deadline at some point, which is not the case for most ship owners. But you know, the risk-return proposition between for a private equity house and a traditional ship owner is very, very similar, if not the same.
Thanks. Just looking at PE activity in shipping in general, is it still fair to say that that's focused more on like joint venture asset plays as opposed to PE houses looking to take a controlling stake in a well-established shipping company? Philip, do you want to comment on that?
Look, I think the industry generally doesn't lend itself for the big sort of buyout funds, what typically is considered to be private equity, who are really looking for franchise value and building a franchise and then trying to exit at some sort of multiple. I think shipping doesn't lend itself to it. There is, it's a commodity business. There's not a lot of secrets here. It's very, very hard to build franchise value, and even if you build it, to get recognized for it. So it's a commodity business. Let's not try and make it more sexy than it really is.
Let me add to that. Basically, what private equity is looking for when they invest is they look to generate value. So there are two possibilities. Either you consider assets undervalued, or at a very low point in the cycle, so where you think that the value of these assets will go up. In that case, you team up with someone whom you consider to be a very good expert in that industry. That's why we've seen the JV structures. Or you invest in a company because you consider the company badly managed, and you think that you know guys that can do better. We've seen that in the cruise industry in 10 years ago, 15 years ago, when Apollo took a position in Norwegian Cruise Lines because they thought they would be doing better than the existing shareholders. And looking back, they have had tremendous success on that. So I think normal shipping, like a bulk company, you can as well buy the assets. You don't need to buy the company.
I would just add to that, I think this panel is a good representation of how private equity is kind of moving into a version 2.0. The first time around, you saw the big multi-strat funds come in. They saw there's distress in the industry, and they came in a big way. Didn't always work out so well for them in the long run, but I think what you're seeing now is they've moved on to do the other investments that they do, and you're seeing much more specialized players are taking longer-term views in the market. I think are being more supportive of the market than you've seen in the past.
Thanks. So, we saw a lot of private equity come into shipping almost a decade ago. How would you describe the interest levels of private equity right now, given what's happened over the course of the last 10 years? Is activity level high? Is it of interest or valuation such that it's still an attractive proposition? Nick?
I certainly think it's still a value proposition, I think, but the views of many of the participants have changed. Like I said before, I think many of the big groups have moved on to other asset classes where they're finding value. Their fund structures allow them to do that. They're given carte blanche to find distress and opportunity. I also think the size and scale, to Philip's point, rapport is not as available as it was. They used the back door of the shipyards in the past to gain scale. I think that's less available today. The public company side, compared to other industries, is very small in this space. There's not much scale you can gain quickly from that there. So I think, as I said before, things have really evolved now. So it's much more niche size. Players are a little more dedicated, have much more knowledge and expertise in the industry. So I think you'll still see some private equity coming in, more likely in more joint venture type structures. But I think it'll be a much smaller scale than we've seen in the last couple of years.
Philip?
Yeah, look, it has its challenges, clearly. First of all, the lack of liquidity, not in terms of the sale and purchase market, but the public markets, which, for all intents and purposes, have been shut for a long while now. And we know there is a whole host of companies waiting to go public, but the window is just not there. And meanwhile, these funds are sitting on these illiquid investments and are staring at these mark-to-market losses, which are really dictated by broker valuations. And then the funds can't lever their investments either because they're not publicly traded. So it's a difficult proposition for most of these participants in the market. But then again, the value proposition is still there. And as Nicholas was saying, for those who can see this and who can navigate these challenges and can structure these investments accordingly, I think over a decent time horizon, you might be looking at satisfactory returns.
We've seen JC Flowers take over or be part of a new shareholding into a ship finance bank in HSH, and of course they've done that in the past with NIBC. Do you think, looking at the difficulties of, as we've discussed earlier, of private equity coming in and taking a controlling stake of shipping companies, that perhaps a more attractive proposition is to look at the ship finance banks, and in particular, as we've heard, there's been a reduction of available finance, whether or not that's something that private equity will look at? Nick, do you want to comment on that?
Yeah, I guess it's also have to look at the zebra and what its stripes do. I think JC Flowers, this is their business of taking over banks and doing that type of structure. I think the majority of this type of capital that's seen the space are coming into it that way. They like to get to the assets through the debt or just get paid back on their debt. So I think I don't see these type of groups. I think that's just what they do. It's a little bit less of where they are in the industry of the cycle. It's just they found opportunity today within the banks. They see distress. They're hopefully buying it at cents on the dollar and able to sell it at a bigger number. The question is, are they able to do that? I think there's been some challenges within this space. Is that if you can't control the asset, or if the owners know you're not willing to take control of it, how well can you really push the price on that there? And I think that would be the question for how well they do in the long run.
Yeah. Martin?
Yeah. Well, I think a lot depends on how private equity can get into a bank. If you have a view that banking long-term is something that's sense-making, I think probably you will not have a view that shipping banking, with the volatility that we have in the industry under Basel III and IV, is particularly attractive if you have mostly lending on your book. So to make a good return on shipping banking, you need to have the broad variety of other products that you can sell to the client, and there are only very, very few banks worldwide that actually have this variety and that can make money that justifies allocating the equity to the shipping industry. So buying a portfolio that has a limited period of time and managing that down, trying to manage it better, that's a proposition that from my point of view makes sense. Buying the entire company, if you know that a good part of it may not have a sustainable business model, is tricky.
Look, I think
it's a question of price at the end.
We see the headline, and we say, we see Cerberus is taking control of HSH, and the natural reaction in trade winds and the press is they come through the back door into shipping. But let's be real. They are experienced financial institutions, investors. They have done this before with other banks that are not exposed to shipping, and shipping is just one of the things that HSH is doing. Admittedly, an important part, but Christian, what is it of the balance sheet? 15%? 10% of the balance sheet. So there's 90% of other things going on in HSH, and all of this will have been priced and factored in, and then they have come to the conclusion this is a good financial institutions investment and not shipping investment.
Thanks. So just looking at the alternative financiers, obviously we've got Meerbaum Capital Solutions here. We mentioned Fleetscape. In this part of the world, we have Clifford Capital. Recently, we've seen Tiger Investments, Real Asset Management set up. I think it was Michael Parker earlier said that maybe some of these organisations would be around for 2 to 3 years, but actually now looking at it again, maybe much longer term. Is that how you see things, Martin, that the alternative finance providers are here to stay?
Well, first of all, I think it's important to understand that all the alternative finance providers are there to fill a gap And that means we are not here to replace NordLB or to DVB or anyone else, but we are here going where the banks currently don't provide funding, or where they provide funding at conditions that the clients don't find attractive. So this is a niche setup for all the alternative finance guys. If you add up the money that we bring to the industry, including the big guys like Breakwater, maybe it's in total 4 billion. That would be high. It's less than that. And that is what HSH was doing as new business in 2006 in a quarter. So we are niche players. And we're niche players as long as this niche is there. And we will, of course, strive to find alternative funding in a different environment from mutual funds or from funds that have lower return requirements. But at the moment, the return of the funding sources and the perceived risk, they match. And so as boutiques, like Philip has been around for 30 years now, 20 years, we'll be there. But our funding sources over the time may change.
And I mean, I think it's fair to say that it's still fertile ground for more alternative finance providers to come into the market. I think we heard that, I think it was Michael who was mentioning about the marine money reduction of banks' balance sheets in terms of ship financing. I think he mentioned a number of 50 billion. And albeit we've seen the Chinese lessors come in aggressively over the last 5 years or so, that it's still a case that there's a funding gap. So do you expect more alternative financiers to come into this space? And if so, how do they price themselves and ensure? Because, you can do 2 or 3 good deals and then one bad deal, it can wipe you out. So what advice would you give to any new finance provider coming into shipping? Can maybe start with Philip and then we can work across to Martin and Nicholas.
Look, I don't want to give advice to others of how to come into this market. I would just say the opportunity is there for as long as the banks are under the regulatory pressure that they are in. So they are very busy. And actually the regulator and their board of directors make it very hard for them to do business in this environment. So to the extent that prevails, there is definitely a place for the alternative providers. Will they all survive individually? Clearly not. But will they survive as a group? I think for the foreseeable future, for sure. And I'm sure there are quite a few plans in the drawer amongst people that are trying to bring new vehicles into the market, and I would be surprised if we don't see a few new entrants over the next months or maybe 1 or 2 years, because it is obvious the banks cannot do all the business that they used to do in the past. So it's potentially on the surface, it looks attractive for others to fill that void.
I'd say more or less similar things, so I don't repeat all of it. There is a demand there. I think the main problem for someone who comes in is to understand the industry. When we had our first TradeWinds article out, we were flooded by people that rightly qualified as crooks. So you've got to know your way around, otherwise you'll be ending up doing all the wrong transactions for the wrong people. And that, I think, is the main entrance barrier for alternative finance. They need to team up with people that know the industry very well.
I think a lot of it's been said already, and I would only just agree that there's a significant need in the market today, and I think those who do well in it will have to have experience to how to navigate the challenging players and the ones who don't necessarily belong in the industry. But ultimately, lowest cost of capital will be an important consideration. And I think another point, I think another panel mentioned before, is where interest rates move over time. I think they have a big function of how successful this strategy will be, because obviously you don't step into this position of taking higher cost of capital unless you have to. And I think the market will ultimately determine where charter rates are at, and how much break-even levels or difference between your break-even levels you have will be a determiner of success in such a strategy.
Well, what we also see is people saying, okay, I have an opportunity now. I want to utilize this opportunity because it's there at this very moment. I don't want the alternative finance capital for forever, but I need like half a year to line up banking finance. And this is what we also see. There's a price to it, but this is, if the opportunity is big enough, it works for people.
Certainly.
And how do ship owners tap up this new capital source? Do you see, do you build relationships directly with the ship owners, or do you still rely on brokers or arrangers to introduce deals and relationships? Could you comment on that, Nick?
I'm not sure if I'm the best one to comment on that, but I think it really drives to, for people who've had experience in the industry for a long time, can really find the best deals. But I'll try the other panelists here.
Yeah. Well, we are say dual setup. I've been at a bank for a long time, so I have a good set of relationships myself. But we work very closely with financial advisors all over the world because our main focus is smaller guys. And for a ship owner that has 5 vessels, it is more sense-making to have a financial advisor who knows the current financial landscape and to point him to the right source of capital rather than have a full-scale guy of the same knowledge sitting in the office and being bored. So we use financial advisors a lot all over the world, and some bring better deals, some less good. And it's our job to judge that.
Yeah, again, I mean, for me, this is not really so relevant. We don't originate transactions so much from ship owners as we do in discussions with banks and institutional investors. So that's where we focus our business development, if you will, and from there we try to develop interesting investment projects.
Okay, we've heard today about the regulatory change, 0.5% cap on sulfur in fuels coming up shortly, a drive in the future by IMO to reduce carbon emissions by about 50% by 2050. Do you think this will create opportunities for alternative finance providers, or perhaps deter them away from the industry? Of course, I mean, as we've heard today, what certain ship owners are going to do in terms of their strategy, in particular for 2020, is far from clear. Some will rely on gas-based fuels or look for the likes of ExxonMobil to produce new fuels that come within the cap, or there's the scrubber option. But I think in terms of, alternative finance providers, for example, just financing new equipment or retrofit of a ship, how would you go about that, and particularly from the security perspective? Would senior finance banks allow you to take a second mortgage on the ship, for example? Martin, have you had any discussions on this?
We had discussions on scrubber financing, and we shelved them at some stage because most owners have a mortgage on the vessels, so you would by definition be somewhere asset-wise towards the end of the chain. And on the cash flow side, it's difficult to snip a small portion of the cash flow to repay the scrubber financing. There is a possibility there that we see, but we have been reluctant because it's relatively complex for small amounts of money. So you don't want for $1.5 million per vessel, pay almost the same money for legal fees.
Sure. And I mean, just to finish off, obviously, private equity is looking for a return. There's lots of industries out there. Maybe Nick, you could kick off. I mean, what are the industries right now which are attracting a lot of private equity interest in that shipping has to compete with for that capital?
Yeah, if you look at kind of the multi-strat funds, or which are the traditional private equity players, but even just normal private equity, they're looking. Energy still remains a very hot topic right now, whether it be the shale game in the U.S. Some of them are starting to look at more and more offshore as a potential opportunity. But I think generally, as well as just good corporate growth right now, I think we're in a good global environment now where businesses are growing and need access to capital. That capital will change over time as some of the debt capital available through excess funding by governments starts to dry up a little bit. So I think that's pulling a lot of the capital right now away from the space. Private credit's also a very hot topic right now within the industry. You're seeing a lot of groups now look to put capital into that space there. They think we're at the end of the private capital cycle, and they're looking to come either take a short position or take companies they may find challenges over time. So I think those are the type of areas I think that shipping capital may have to compete with, at least from the private equity groups.
Sure. Philip?
I only know shipping.
Any closing remarks, Martin?
No, fine.
Okay, I think our time's up. So thank you all for joining this panel. And I don't think we've got time for questions, but perhaps in the next interval.